Mr. Ashok Tyagi, whole-time director and CEO at DLF Limited, who's joining us now. Mr. Tyagi, if my memory serves me right, you joined DLF in 2008, the middle of the year, middle of the great financial crisis. You're now the whole-time director and CEO. You've done it from 2008 till now, and the next 13 years, but the next 13 months, going to be a roller coaster ride for real estate, or things have stabilized, only one way to go, which is north after so many years?
So good morning. You're right. I mean, thanks for reminding me that I joined not at the middle, but almost at the start of the global financial crisis, where sometimes I get the wrong feeling that maybe I started in the first place. But look, the next 13 months or the next 12 months, whatever, clearly the real estate sector, especially the residential sector, has been, in the midst of a great bounce back almost the last 18 months now. And but the inflationary impact on the commodity, which had started to increase the cost of construction, and then clearly the interest costs inching up now, at least should make us slightly more cautious about the next 12 months growth. Then I think the growth trajectory will continue, but it may become slightly more nuanced, especially if the interest rates go up by, say, a further 150 basis points or something.
Okay, so you think that right now there's not so much bad news for real estate. In fact, we're seeing cash holdings in the equity markets also at an all-time high. That usually augurs well for the property market. But Mr. Tyagi, what I would also like to get a sense from you is, we've been hearing about these record sales from DLF. For the last couple of years, DLF had started to go slow on launches. Has that now officially changed? Will we see the DLF with the same kind of aggression that we used to see last decade?
Okay, so clearly you will see an increased pace of launches for sure, which is already reflecting in terms of higher sales volumes. I think we've also laid out a pipeline of almost 45,000 crores of a sales pipeline across the next year, maybe the next four to 5 years, depending on how quickly it's absorbed. To your question of whether this means reverting to say the aggression of 10 years back, I hope not, because clearly we have become far more cautious in terms of where to launch, what to launch, when to launch, at what prices to launch. And I do hope that frankly a lot of issues which not only DLF but the industry faced could be linked to some of the ultra-aggressive approach in, say, the 2007 to 2010 timeframe, not only for a specific company, but I think for the industry. And I do hope that at least the bigger and the more credible players, avoid repeating the same set of mistakes again.
So, Mr. Tyagi, we're also talking at a time when there is inflation. So while, the property market is making a comeback, how serious a threat is the property market's revival when we look at it with inflation? I'm guessing real estate companies will have to hike prices just the way the commodity prices have also been moving. And let's not forget, home loan rates will also be going up.
Okay. So, as far as the commodity inflation is concerned, in the last 12 odd months, the cost of construction has gone up by between 12 to 15% of the cost of construction. So clearly a product being launched today is going to cost about 12 to 15% more to construct than if it were launched, say, 15 months back. That's a fact. That's out there. To offset it for the kind of premium and luxury projects that we typically engage in means about a 4 to 5% increase in prices, which at least so far has not been an issue on an annualized basis in the last couple of years. Now, going forward, I do believe that for the right projects, the market would always have the runway to absorb that degree of price increase. The home mortgage rates is clearly a more complex issue, because if you see the home mortgage rates were at the 6.5%, 6.6% for now the last few years, which was one of the biggest reasons for the revival of the sector. I mean, they already gone up to the early sevens now. Based on our past experience, and again, past is not necessarily a mirror to the future, Till about the early 8.25-ish numbers, the home demand does not directly get impacted. But if the interest rates cross, say, the 850 mark and start approaching 9, then clearly I think it will start having a bearing on the general enthusiasm that people had in terms of taking home mortgages. That is clear. As far as right now, what's happening is that because it's been 50 to 90 basis points increase, people's tenor is increasing, their EMIs are not necessarily going up. But I think at some stage the EMIs will also start going up sharply. And I think so it's really an issue of up to what stage is the interest rates finally capped? Is it 775? Is it 825? Anything which starts approaching the 850, I think clearly then people do tend to become cautious if the past is any indicator to go by.
You already told me that how lessons have been learned over the last decade when it comes to expanding too fast, not buying land at the right price. What I also wanted to get a sense from you, Mr. Tyagi, is the commercial real estate segment. I'm talking about offices as well as malls. With the world reopening, offices, reopening, people going back to malls for revenge shopping, restaurants being full as well. Is DLF going to step on the gas when it comes to commercial real estate and the past negotiations which may have taken place with tenants? Is that all over and done with, and have rentals normalized?
So, the malls have been a sensational story because they shut down completely in the lockdown because that was the regulation. But they've almost bounced back like a V, absolutely. In fact, the footfalls today are 90% plus of pre-COVID levels. And the shopping, the shopping per footfall is in the range of 130 to 150% of the pre-COVID levels. In the luxury segment, actually, the Emporio and the Chanakya Mall, etc., the bounce back is even sharper. So clearly, we are again focusing very strongly, to your point, on the retail segment development. We are building. We are in the process of designing and building 3 shopping complexes, not necessarily malls, but neighborhood shopping complexes. One in DLF 5 on the Golf Course Road, one in near our Midtown project, and one in Goa. We are also in the early stages of the designing of a big Mall of India like project in Gurgaon in our downtown complex, which should be a pretty major, development. It will be bigger than the Mall of India Noida for sure. So it will possibly be the biggest mall. So clearly, I think we have, contrary to what people used to believe that e-commerce and online shopping will sound the death knell of the retail experience. Actually, the experience has actually been exactly the opposite. And we today feel extremely strong about the retail story. As far as offices is concerned, the offices vacancy levels, had gone up from the conventional 4-5% to almost 15%. Not only for us, but if you also see the other listed REITs, you'd find the same numbers there. In the last quarter or so, they've clearly begun reversing. I think today our vacancy levels are around 12%. And we do believe that hopefully if there is no major recurrence of the pandemic, which again becomes threatening enough for offices to get shut down, I think maybe max by the end of this fiscal, we should be in the mid-single digits from a vacancy standpoint. That's the hope. We are not cutting down on capex, so we are building downtown in Gurgaon. We are building a major complex in Chennai, and we have also kicked off construction in our JV with Hines on the national highway.
Okay, so that's quite a strong launch pipeline that we're seeing over there, and that's all the time we have for today, Mr. Tyagi. But you've joined us on our 13th birthday. Do you want to share with us what your anniversary wish might be for us and why you like watching ET now?
No, honestly, I've always enjoyed my interactions with ET now, with all of you, with you, Aisha, Nikunj. It's always been an extremely good experience. ET now also has been always, a very, very incisive and I'd say, an analytical news channel. So rather than a sensationalist one. So frankly, I've always enjoyed my interaction, and hopefully 13 done, hopefully 30 more at least, and then let's talk.
Thank you so much, Mr. Tyagi, and it's always good hearing your insights. Thank you.